Good afternoon. It's Jeffrey Christian. It's not quite 3 o'clock on Thursday, the 17th of November. I will be out of the office on Friday, the 18th, so I'm recording this today for release on Friday. I wanted to talk today about cryptos. They've come up and people have been asking us questions about it. It's something that we've followed closely really since 2009. And the title here is Cryptos Are Not Precious, Gold and Silver Are. And that has been really our position all along since cryptos began to emerge around 2009. We have always held the view that cryptocurrencies are really the antithesis of gold and silver. I'll show you why. They're intangible, they're ethereal, they have other issues distinguishing them from tangible assets such as gold and silver, precious metals. Cryptos are akin to those thousands of internet stocks that bubbled up in the late 1990s and then burst in 2001. And you had, I think, about $5 trillion of investor losses, money that had poured into these internet stocks. I remember seeing several. One of them was three guys who were in college together. They were living in a dorm, and they had a 5-page business plan, which was really more of their concept of what something could be. No economics, nothing about their ability to execute on their idea. And I think they raised more than $100 million on it. We had one client who had sold his company a few years earlier. Merrill Lynch had acted as a sales agent on that. He put some of his money into a Merrill Lynch internet stock fund, and he put some of his money into gold and platinum. And he made as much in the gold and platinum as he had lost in the internet stock in 2001, 2002, 2003. Longer term, we think that private cryptocurrencies are likely to disappear. And they're going to likely disappear in an ugly fashion that's going to cost investors a lot of money. Digital national currencies are likely to emerge in the long run, but they'll be backed by the faith and credit of the governments that are issuing them, the same way that paper currencies and bank accounts are now. All of this information is in a 5-page market alert that CPM Group has issued as of the 17th of November, talking about cryptos are not precious, but gold and silver are. Did this cute little graphic here. Gold's a tangible asset. You can hold it. It has limited but liquid supply. There are billions of ounces of gold in the world, but there's a geographic limitation on the availability of gold for investors. It's no one else's liability. You have no one else to worry about in terms of the value or ownership or title of your gold if you own it and you have it safely stored. It's a big if you have to pay attention to. And the value is determined daily by a market with millions of buyers and sellers. In the middle of this chart is national currencies. These are intangible assets. They're based on the full faith and credit of the governments that are issuing them. There is an unlimited supply. And the value is determined daily by the market with millions of participants. Some people wax nostalgically about the old days of fixed currency markets, but fixed currency markets were terrible. And what you would have is you'd have imbalances between the economic value of a currency and the stated fixed currency value. And ultimately, you'd have to have devaluations or revaluations of the currencies, and you would have governments making these decisions, and there'd be this ratcheting, wrenching readjustment with every devaluation or revaluation. There's a great book on currency systems in the post-war period through 1971 that discusses this. And people seem to have forgotten the problems of that. Rather than having governments occasionally decide what the value of their currencies ought to be, we now, since 1971, have the value of those currencies determined daily by a market with millions of participants, floating exchange rates. Looking at cryptocurrencies, they are the ultimate intangible. It's not even a piece of paper. There's no government that you can complain to when something goes wrong. There is an unlimited supply. Some issuers will say that, oh no, they have agreed to not issue more than a certain volume of cryptocurrencies, but that is someone's decision. The same way that a national government, a treasury or a monetary authority in a government can say, oh no, we don't have unlimited ability to issue our currency. We will limit our currency to some sort of parameter. And those kinds of limitations are artificial, and they can be changed on a moment's notice by someone other than you. Cryptocurrencies are based on the full faith and credit of someone that you don't know and you don't really have a recourse to. In the early days, well, not too early of days, several years ago, there was a scandal where there was about $500 million lost in cryptocurrency in Japan. And a lot of the people who had invested in this currency couldn't figure out to whom they should complain, because there was no one to whom they could complain that had any authority over it. There was an anonymous person who had issued it someplace and things had gone wrong. And there was a crowd of people who gathered at an intersection in the Ginza in Tokyo, protesting and wondering to whom they could complain about the fact that they had suffered $500 million in losses. The value is determined daily by a market with unknown volumes of participants. So cryptocurrencies are the antithesis of gold and silver. They are the ultimate intangible asset. They are a chip on the internet, controlled by who knows whom. Now, the current scandal isn't the first, and it hasn't been the last. It won't be the last. There have been dozens of scandals, from frauds to scams to thefts in the cryptocurrency market. And as some blackmailers have discovered, certain governments have developed the ability to come in and reverse transfers of cryptocurrencies. The FTC, the Federal Trade Commission in the United States, estimates that in 2021 alone, $1 billion was lost in cryptocurrency scams. That was up 60-fold from the losses that were reported in 2018 in crypto fraud. It was fully 25% of the frauds reported to the Federal Trade Commission last year. And it was due to outright fraud and theft. It didn't account for the losses due to wild declines in value. There's a company called Chainalysis, which estimates that more than $3 billion in crypto value was stolen in the first 9 months of this year alone. And they said that was down from down 65% from an estimated amount of losses in 2021. So obviously the $1 billion that the FTC reported were only the $1 billion that were reported to them. On a global basis, it was a much larger loss. And there's another company called Glassnode, which estimates that 40% of the Bitcoin holders were at a loss in their Bitcoin holdings as of May 2022, this past May. Bitcoins peaked, I believe, in November of 2021. And by May, the prices had fallen to the level where 40% of those people owning Bitcoins were estimated to have a loss in their Bitcoin investments, if you want to call them investments. Bitcoins since that time have lost another 41% in value. And a word about the volatility of cryptocurrencies. You say, where do I see the kind of trading patterns? Where do I see the kinds of volatility in prices? Where do I see the kinds of returns that I see in gold and silver? And where you see that is in the US dollar and other major liquid currency markets, and in the treasury bills and bond markets. Gold and silver trade like currencies. You say, where do you see the similar trading patterns that you see in cryptos? They're almost identical to slot machines in casinos. So that's what a crypto is. Now, where are the regulators? Central banks have taken a hands-off approach toward cryptocurrencies for most of the period since 2009. That's starting to change now. But monetary authorities around the world looked at the cryptos. They said, these things are like the tech stocks or like pet rocks. You know, there's going to be a lot of money lost in cryptocurrencies. We don't want to be the regulators who impose regulations in this unregulated market that might tip the scale and cause those losses to occur. So we're going to stand aside and let these cryptocurrencies implode on their own, and we won't be blamed. Kind of abrogating those responsibilities, like, the SEC is chartered to protect the investing public. Say, no, hands off. That started to change, and it started to change for a few reasons. One is that when central banks and monetary authorities were saying that, they were looking at a $500 billion market, which is very small compared to the trillions of dollars and quadrillions of dollars that are traded in stocks and currencies and commodities and bonds and the derivatives of those markets. Over the last 2 years, the amount or value of cryptocurrencies have gone from $500 million to $1 trillion to $2 trillion to $3 trillion. And the number of cryptocurrencies being issued have gone from a few hundred to more than 10,000. And regulators said, okay, now we've got serious amounts of investor money there that is at risk. In addition to that, you have major institutional investors, financial banks and brokerage houses and insurance companies investing in cryptos. So an implosion of the crypto market could have negative consequences for the broader financial markets. So regulators have begun looking at how they should regulate these things. They really don't want to take the blame for the implosion that they assume is negative and is coming. But they've realized these things have gotten to the point where the public really needs protection. In addition to that, Gary Gensler has become the chairman of the Securities and Exchange Commission, and he has a much more, let's say, moralistic or ethical approach toward regulations of financial markets. He started his career at Goldman Sachs, as I did, and he left at some point in the 90s and went over and became a legislative aide in Congress. At one point, he took over as chair of the CFTC and brought in people who built out a very viable and effective market supervision and oversight operation to allow the CFTC to start cleaning up the commodities markets from some of the malfeasance there. And now he's in charge of the SEC. Another reason is that I guess there was some bureaucratic discussions as to who really should be regulating the current cryptocurrency markets and how they should regulate them. And some of those discussions have ultimately led to conclusions. So you're now starting to see the United States government look at regulating these markets. China last year banned all cryptocurrencies. Now, there still are cryptocurrencies trading in China, seemingly at odds with the regulations saying that these cryptocurrencies are not supposed to be traded anymore. But China has said, no, this stuff is too dangerous. Investors will lose their money. We don't like the creative destruction concept of capitalist America, where you can say, well, in order to have a vibrant economy, some people have to be allowed to fail and lose vast amounts of money. The Chinese Communist government says, no, we should try to avoid that creative destruction of the pseudo-laissez-faire capitalists that run the United States. 8 other countries have also banned cryptocurrencies. And now the European Union and the United Kingdom are starting to look more seriously at what sorts of regulations have to come. So regulators are coming. Hopefully it's not too little too late, but it is coming on the horizon. So what's all this mean for gold and silver? It's good. We've said all along that we thought that in the short run, cryptos have not had a major effect. If you look at the $3 trillion, it's not really $3 trillion. If you look at the money that's been diverted from investing in gold and silver into cryptos, it's a minuscule portion of the amount of money that has been diverted from precious metals into stocks and bonds over the last few years. So cryptos have had a marginal impact of distracting investors from investing in gold and silver compared to stocks and bonds. And that's probably going to continue to be that way. In the long run, our view is that cryptocurrencies will implode. There will be bigger issues. There'll be more thefts. They will go the way of the tech stocks. Larger investors will lose more money, and that will refocus investors' attention on the values of owning some gold and silver, real tangible assets that are the antithesis of cryptocurrencies. And then the other thing that we see in the long run is that national government-issued digital currencies will emerge in the future. And that's part of the natural technological transformation of money from gold and silver 500 years ago to script privately issued by private banks in the 19th century, issued by central banks. Well, the British and the French had central banks from the 1700s. Italy, Germany, the United States had central banks that started issuing currencies, in Italy's case, the 1890s, Germany, the 1920s, the United States, 1914. There's a natural technological evolution to currencies, national currencies, and the future holds national digital currencies. That's the way it is. That too, we think, will be helpful stimulating investment demand for gold and silver, and thus the price of gold and silver. Because any number of investors will say, I'm completely comfortable with a digital financial system, but I still, the digital financial system is dependent on national governments, financial industry infrastructure that can handle it without failing, digital record keeping, and electricity, both in your house and on a national level. And electricity, as we all know, has a lot of issues in terms of supply and stability of grids and being vulnerable to interruptions either through technical problems or malfeasance, people coming in and hacking into electrical systems. So just like you want to have a set of paper documents that say, oh, this is what I have in my bank. It's fine to have get your records delivered electronically, but every so often you want to print them out and have a printed record in case the electricity goes out. The same way you probably want to have some gold and silver. So we think that cryptocurrencies, private cryptocurrencies, are good for gold. They're not necessarily negative, have not been necessarily negative over the last several years. And they're probably going to be much more positive as they implode and refocus investors' attention on gold and silver and the values and attributes of gold and silver that make them valuable as investments, as safe havens, as portfolio diversifiers. And we think that the rise of digitalized currencies on a national government issue basis also will help stimulate investor interest in gold and silver. That's all we have for now. Have a good weekend. Take care of yourself. Take care of those around you and everybody else, because everybody really needs to get together and try to make this world a better place. We'll talk to you next week.